Good afternoon, everyone, and welcome to the Tax Implications of the CARES Act. My name is Brandy Benoit, and I'm a tax partner with Johnson Lambert. First and foremost, we would want to thank all of you for taking the time to spend with us today. We know there's a lot going on in the world right now, and we hope that you and your families and your loved ones are staying safe and healthy through all of this. Amongst everything else we're having to deal with of what the new normal is, we also are trying to wrap our heads around the implications of the new CARES Act. Therefore, for the next hour or so, we're going to share with you what we've learned and what we are hoping to share with you so that you can learn something about some benefits that would be available. We're going to focus primarily on items that we feel like are most impactful to our clients and our friends of the firm. Also, as a disclaimer, I'm sure as all of you guys listening are working from home, all of the presenters are working from home as well. So hopefully this will all go off well, but definitely as a disclaimer, please pardon any background noises from children, animals, anything else that might happen. But thank you for your understanding of that. I definitely know that we all keep hearing this, but this is an unprecedented time. And with that, it's also very unique that we are hosting this conversation day with our entire client base and friends of the firm. We have people that are participating from all the industries we serve, people from the insurance, not-for-profit, and employee benefit plans areas. We are all, regardless of our location or our industry, impacted by this pandemic. And we are also trying to learn things that we can do to help ourselves and our companies get through this time. So today we hope that the discussion of the CARES Act can help you and your organizations. We will discuss today the implications of the CARES Act for organizations and operations in general, but of course we are happy to help any of you with any specific questions you have about your organization. Please feel free to reach out to any of us on the presentation today or anyone at Johnson Lambert if you have something more specific that you want to understand for your organization. If you do have any general questions that come up as we're going through the presentation today, please feel free to ask those through the Q&A function on the On24 console. We will do our best to answer as many of the questions as we can at the end of the session. Before I introduce the rest of the presenters today, I would like to take a moment to cover a few other administrative items with you. You can download a copy of today's presentation from the resource window. We have also placed a few recent articles on these topics in that resource section. If you experience any technical difficulty during the webinar, please click on the help icon. For those interested in receiving CPE or CRE for participating in today's webinar, you will need to go to the certificate icon. You can launch the certificate window to monitor your progress towards earning the certificate. Once you've met the criteria, you will see the certificate image in the window. Click on this image and download your certificate. This is the only way to obtain your CPE or CRE certificate is by downloading it through this platform. Credit is not available for group viewings. Johnson Lambert will use polling questions for credit verification during this session. To receive your 1-hour CPE or CRE credit for today's session, you'll need to be present for 50 minutes and answer at a minimum of 3 polling questions. So without further ado, I'm pleased to announce the presenters today who are joining me. First, I'd like to introduce Alan Autry, who is a tax partner in the insurance group. We also have Craig Geston, who is a tax manager also in the for-profit side, as well as Jason Jackson, who is a member of our not-for-profit team. So we hope to cover a lot of areas over the next hour or so. With that, we are going to be discussing some of the COVID-19 changes in the tax rules, as well as an overview of the recent CARES Act. In addition to the overview, we're going to dig into a little bit more detail related to payroll tax provisions, as well as corporate tax provisions. Then we're going to also discuss any not-for-profit considerations related to these changes. And we'll wrap up with some other thoughts that you can take away and apply to your organizations and hopefully have some additional information to move forward with. So with all that, we're going to get started with the first polling question. So the first polling question is, how many webinars on the COVID-19 stimulus have you already listened to? More than 5, between 3 and 5, less than 3, none, this is the first one, or not applicable. I'm sure all of you guys are inundated with all of this information and tax law changes as well as everything else. So I'm interested to see the answer here. All right, and it looks like there's definitely been, some of you have listened to some other sessions, so hopefully you know a little bit of this, but we can provide you with additional information today. And with that, I will turn it over to Alan to start discussions of the COVID-19 tax implications.
Thank you, Brandy, and good afternoon to everyone. Obviously, we're in unprecedented times for us as a nation. The government felt like it had to react to the situation and provide liquidity and cash flow for individuals and companies alike to help them get through the economic impact of this pandemic. So on March 27, 2020, the IRS and Treasury were implemented to have this Coronavirus Aid, Relief, and Economic Security Act, and it was more than $2 trillion package meant to address the economic impacts of the COVID-19 outbreak. Its main goals were keeping workers paid and employed, healthcare system enhancements, and economic stabilization. There were also some emergency appropriations for the coronavirus health response and agency operations. And we'll be going over this in a lot more detail later. In the COVID-19 tax changes, there's a big relief for most taxpayers, including us practitioners, that on March 21st, the Treasury Department and IRS announced the federal income tax filing due date was automatically extended from April 15th to July 15th. Taxpayers can defer their payments without penalties or interest regardless of the amounts owed. This deferment applies to all taxpayers, including individuals, trusts and states, corporations, and other non-corporate tax filers, as well as those who pay self-employment tax. If additional time is needed to file a complete and accurate return past this July 15th deadline, an extension can be filed by that date to extend the deadline until October 15th. I'm sure taxpayers are asking, with the extension payments and Q1 estimated tax payments extended until July 15th, when are the Q2 estimated tax payments due? As of right now, those Q2 payments are still due on June 15th. The federal extension of the due date and payment is only applicable to payments and forms for the due dates of April 15th, 2020. No other payments for forms have been extended. On the state side, they're reacting to the change in due dates at the federal level. State return due dates for calendar year end taxpayers have changed. 44 out of the 50 states have moved the due date to at least July 15th. Payment deadlines have also moved. However, I have put a link down here in the bottom. There is a lot of different movements between the states. Some states are still charging interest on payments after the original due date and no penalties. Some have moved the due dates altogether. So this link should provide you up-to-date status on where each state stands for additional forms and or corporate and individuals. But something to point out that I want to make sure people are aware of. Mississippi has changed its due date to May 15th. Virginia filing date of May 1st. However, the payment is not due until June 1st. Idaho, New Hampshire, and Washington now have due dates of June 15th. And Connecticut has a due date of June 15th for corporations. However, they have a July 15th due date for individuals. And with that, I'm going to pass it over to Craig to talk more about the CARES Act implications on the individual provisions.
Thanks, Alan. As Alan has said, this is a very expansive bill that gives relief to not just the business community, but to individuals as well. The three major tax provisions for individuals are the recovery rebate distributions, relaxed rules for the use of retirement funds, and modifications to the limits on charitable deductions for 2020. And I'm going to go over all these in the next couple slides. One of the ways that this bill is adding stimulus to the economy and helping those affected by the pandemic is by issuing direct payments to individuals through what they have called recovery rebates. This recovery rebate is actually a 2020 refundable credit that the IRS will be issuing hopefully in the coming weeks. The maximum amount of this credit is $1,200 for individuals and $2,400 for those that file a marriage filing joint return, with an additional payment of $500 for each qualifying child. This credit is phased out for adjusted gross incomes greater than $75,000 for single taxpayers and $150,000 for joint taxpayers at 5% per dollar of qualified income, or a reduction of $50 per $1,000 over the limit. So the credit will be completely phased out at $99,000 for individuals and $198,000 for married joint filing taxpayers. Now, this credit is based off your filed 2019 tax return if that return has been filed already. And if not, then the credit will be based on your 2018 filed tax return. Since this is a 2020 credit, but based on 2019 or 2018 amounts, you might actually have a larger credit when filing your 2020 tax return. If this is the case, then you will receive an additional credit on that 2020 return. Now, if it goes the other way and you should have received less of a credit based on your 2020 income, that amount will be forgiven and you will not have to pay it back. So, I mean, theoretically, I could have won the lottery in 2019 and not have filed my 2019 return yet, and I'm still able to receive this credit if I was under those thresholds in 2018. It's also important to note that these rebates will not be counted as taxable income for federal purposes. This act also allows taxpayers that have been affected by this pandemic to take up to $100,000 in distributions from qualified retirement accounts, such as a 401k or an IRA, without being subjected to the 10% early distribution penalty. Normally, if an individual takes a distribution from their qualified retirement plan before the age of 59 and a half, the IRS not only charges you tax on that distribution, they also tack on a 10% penalty. These distributions can be taken up until December 31st, 2020, without that 10% penalty. And they will be taxable evenly through over the next 3 years. However, these amounts can be contributed back to your retirement accounts in this three-year period, and they will not count against your contribution limits for that year. The bill also allows for a $100,000 loan to be taken against qualified plans, and repayments of these loans can also be delayed. In addition, the bill temporarily suspends the required minimum distribution rules for 2020. Now, the reasoning behind this is that the IRS doesn't really want to force individuals to take money out of the market that has been declined due to this pandemic. The last major individual tax provision is the changes to the charitable deductions. This bill has created a above-the-line deduction for 2020 of up to $300 for charitable deductions. When I say above-the-line deductions, this just means that everyone will be allowed to take this deductions, not just taxpayers that are able to use the itemized deductions. With the passing of the Tax Cuts and Jobs Act, there were a large number of individuals that no longer were able to itemize and therefore did not get additional tax benefits for charitable donations. Because of this, there was a decline in charitable donations over the past year, and this change will now allow all taxpayers that donate to qualified organizations a deduction. In addition, the charitable limitations have also increased to 100% of adjusted gross income for individuals and 25% for corporations, which Alan will discuss a little later. So back to my dream of winning the lottery. Now, if I wanted this year, I could now actually donate the entire proceeds to charitable organizations to help people in need from the pandemic and be able to take the full deduction. Okay, now I'm going to move on to a provision that affects small businesses. The bill includes a loan program for small businesses called the Paycheck Protection Program. This program authorizes $350 billion in forgivable loans that can be used to pay employees during this crisis. And this will be administered through the Small Business Administration. All businesses, including non-for-profits, veteran organizations, sole proprietorships, self-employed individuals, and independent contractors with 500 or fewer employees are qualified for this loan. The loan can be applied through an existing SBA lender or through any bank or credit union that's participating. So this is a new program that's just been rolled out fairly quickly, and there's a lot of unanswered questions that have been arising through all of the information that's been given. So over the past couple of days, there's been a lot of banks that have came out and said they're either not participating in the program, or I've heard that some are going ahead and accepting the applications, but they're not giving cash out until further guidance is given. So there is a possibility that your bank will not be participating in this loan program. The maximum amount of the loan is the lesser of $10 million or 2.5 times your average monthly payroll cost. And there's been a lot of debate on what payroll amounts should be used for this calculation. So the Treasury Department came out on Monday with a frequently asked questions document that states that a loan applicant should use gross payroll versus net payroll. This would include federal withholding payments and the employee's FICA taxes, but the employer's portion of FICA taxes are excluded. Also included in the average payroll calculations are payments for vacation, parental, family, medical, or sick leave, payments of any retirement benefits, and payments for state and local tax assessed on compensation. The amount can be calculated using aggregate payroll costs using data either from the full calendar year 2019 or from the previous 12 months. Also, these payroll costs are capped at $1,000 annualized basis for each employee. However, this limitation does not include healthcare costs, retirement benefits, and state and local taxes. The $350 billion that's available is on a first-come, first-served basis. So if you're considering this loan, you will probably want to act quickly. You know, there's been a lot of talk in the last couple of days of increasing funds to this program. I read yesterday that they're trying to secure an additional $250 billion for this program, but that is completely up in the air as of now. The terms of the loan are the same for everyone, with a 1% interest rate and a 2-year repayment period. The payments of the loan will be deferred for 6 months. As noted, this loan can be forgiven as long as the loan proceeds are used to cover payroll costs, most mortgage interest, rent, and utility costs over the 8-week period after the loan is made. And employee and compensation levels are maintained. The government's now advising that because of high participation rate, it's anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. The loan forgiveness cannot exceed the principal. Also, the loan proceeds are not treated as taxable income if they are forgiven, as is the case with other loans. Now, there's some uncertainty of whether or not the expenses that are used from these funds would be able to be taken as a deduction if no taxable income is being included from the forgiveness of this loan. So we're likely going to have to wait for further guidance to make this determination on these expenses. In addition, if this loan is forgiven, then the following payroll tax provisions in the upcoming slides are unavailable to your business. So the 3 payroll provisions that are included in the CARES Act are the ability for advanced refunds of credits from the Families First Coronavirus Response Act, which was passed a week before the CARES Act, an employee retention credit, and they're allowing to delay the employer portion of Social Security tax. So the 2 credits included in the Families First Coronavirus Response Act that are allowed to be taken as advance payments are the Qualified Family Leave Credit, which this credit allows employers with fewer than 500 employees to provide public health emergency leave when an employee is unable to work or telework due to the care of a son or daughter under the age of 18 because the school or place of care has been closed or the child care provider is unavailable due to a public health emergency related to COVID-19. The second credit is the Qualified Paid Sick Leave Credit, which requires employers with fewer than 500 employees to provide up to an additional 80 hours of paid sick time through the end of this year. This 80 hours is in addition to your company's paid leave policy. If an employee is unable to work due to any of the following, if they're being quarantined or self-quarantined, have tested positive for COVID-19, or the employee is caring for someone who is quarantined or self-quarantined, caring for someone who has tested positive for the virus, or the employee is caring for children whose school has been closed because of COVID-19 precautions. Employers with fewer than 50 employees can be exempt from this requirement, and self-employed individuals are also permitted to receive this credit. There are different amounts of credit available depending on if your employee themselves is sick or if they just need time to care for an eligible child. These advance payments from the credits, along with the credit on the next slide, can be taken as early advance payments by filing Form 7200 before the end of the month following the quarter in which the employer paid the qualified wages. Okay, so the CARES Act included an additional credit on top of those previous 2 credits called the Employee Retention Credit. This credit is available to all employers regardless of size and is designed to encourage businesses to keep their employees on their payroll by providing a refundable tax credit of 50% up to $10,000 in wages paid by an eligible employer whose business has been financially impacted by COVID-19. To be an eligible employer, your business has to be fully or partially suspended by government order due to COVID-19 during the calendar year, or your gross receipts are below 50% compared to the same quarter in 2019. Once the employer's gross receipts go above 80% of a comparable quarter in 19, the employer is no longer qualified for this credit. The qualifying wages are based on the average number of employees in 2019. However, for the purpose of this credit, eligible wages do not include wages counted for purposes of the paid sick leave and family leave payroll tax credits. Employers with fewer than 100 employees, this credit is based on the wages paid to all employees, regardless of whether they worked or not. If the employees worked full-time and were paid for full-time work, the employer still receives the credit. If employers have more than 100 employees, then the credit is allowed only for wages paid to employees who did not work during the calendar quarter. Employers can be immediately reimbursed for the credit by reducing the required deposits of payroll taxes that have been withheld from employees' wages by the amount of this credit. Eligible employers will report their total qualified wages and the related health insurance costs for each quarter on their quarterly employment tax returns, or Form 941, beginning with the second quarter. If the employer's employment tax deposits exceed the credit, the employer may receive an advance payment from the IRS by submitting that Form 7200. Another payroll tax provision included in the Act allows employers to delay their portion of Social Security tax, with 50% of the payments due December 31st, 2021, and the remaining 50% due December 31st, 2022. We've been told by our payroll provider that they think the IRS will issue a form that will need to be filled out in order to delay these payments. However, this is another item that we are still waiting for further guidance on to be able to know how to actually defer these payments. As a reminder, businesses are not allowed to forgive the loan under the Paycheck Protection Program and delay their payroll taxes or take one of the previous payroll tax credits that I described on the previous slides. They're not allowing you to double dip with both of these stimulus provisions. So you have to either decide if you want to take the loan or take the payroll tax credits and the deferral. The final payroll provision is that the 2020 minimum required contributions for single employer plans are delayed until 2021. With that, we have our next polling question that I will give it back to Brandy for. Oh, it looks like Brandy's not there. So I guess I'll go ahead and read it. Will your company file for an SBA loan? A, yes. B, no. C, we haven't evaluated yet. Or D, NA. And I'll give you some time to answer that. Okay, that should be enough time. Looks like the 49% of you are saying no, we will not be applying for the SBA loan. With that, I am going to turn it back over to Alan Autry to talk about the corporate provisions.
Thanks, Greg. As mentioned earlier, the government was attempting to have increased cash flow and generating liquidity for corporations. On top of the Paycheck Protection Program and deferral of payroll taxes, here are some of the approaches they took in trying to get cash to corporations quickly and allow them to keep their doors open and employees paid. Some modifications include the net operating loss rules, AMT credit, business interest expense. They made a technical amendment on qualified improvement property, and they made some modifications to limitation of charitable contributions, and then treatment of federal loans, loan guarantees, and other investments for larger corporations. So before we get into the modifications for the net operating losses of what the CARES Act did, let's talk about what was in place before. Under the Tax Cuts and Jobs Act, it limited the net operating losses generated by C corporations and life insurance companies beginning in the year 2018 to offset only 80% of taxable income with the option of without an option of carrying back. However, they could carry the net operating loss forward indefinitely. Property and casualty insurance companies were able to stay with what they had prior to the Tax Cuts and Jobs Act of a 2-year carryback and a 20-year carry forward with no threshold offset on the taxable income side. The CARES Act has repealed the 80% limitation for tax years beginning before January 1st, 2021. And it also provides that net operating losses arising in taxable years 2018, 19, and 20 are allowed to be carried back to each of the 5 taxable years preceding the taxable year of such loss. The temporary repeal of the 80% limitation, when coupled with the new 5-year NOL carryback period, affords corporations the ability to utilize net operating losses in taxable years beginning in as early as 2013 for net operating loss experienced in the 2018 taxable year. And it also allows the offset of taxable income in those years prior that had been subjected to the 34 or 35% rate. This 5-year carryback also applies to the property and casualty insurance companies for the 2018, 19, and 20 tax years. And I think overall these changes are intended to allow corporations to go ahead and utilize the net operating losses and amend prior year returns, which should start helping in providing that additional cash flow and liquidity. As mentioned, another modification was to the AMT credit rules. The Tax Cuts and Jobs Act repealed the corporate alternative minimum tax for taxable years beginning after December 31st, 2017. The Tax Cuts and Jobs Act made the AMT credit a refundable credit for any year beginning after 2017 and before 2022, equal to 50% of the excess of the minimum tax for the tax over the amount of the credit allowable for the year against the regular tax liability imposed for that taxable year. So to put it in layman's terms, the AMT credit that is remaining after covering your regular tax liability, 50% of that amount was refundable each year starting in 2018, and any remaining credit would have been fully refundable in 2021. The CARES Act amends the rules for taxable years beginning in 2019. The AMT credit is fully refundable and after it offsets any current year tax liability one might have. So for those that have not filed the 2019 tax return yet, go ahead and fully refund your AMT credit. And for those that have already filed your 2019 tax returns and have an AMT credit available, they can amend their tax returns to get the credit refunded. Now to discuss the limitation of the business interest. The Tax Cuts and Jobs Act implemented Section 163J, which limited corporations to an interest expense of 30% of their adjusted taxable income. The CARES Act changes Section 163J for the 2019 and 20 tax years to adjust the taxable income threshold to 50%. The CARES Act also allows the taxpayer to elect to use their 2019 adjusted taxable income as their adjusted taxable income in 2020. Congress offers this election due to the current economic environment, thinking that taxable income for most of the companies will be higher in 2019 than in 2020, which in turn will allow more interest expenses to be deducted. The temporary 50% threshold and ability to use the 2019 adjusted taxable income for 2020 is expected to significantly increase the ability of taxpayers to deduct interest in 2019 and 2020. To the extent that net operating losses arise in 2019 or 2020 on account of either an increased Section 163J limitation or the treatment of excess business interest expense allocated to a partner for a taxable year beginning in 2019, that net operating loss is now available for carryback and is not subjected to the 80% limitation. So one of the technical corrections that the IRS made was, the Tax Cuts and Jobs Act amended Section 168 to exclude qualified leasehold improvement property from the 15-year property classification and thus defaulted the property to 39-year property classification that is not eligible for the additional first-year bonus depreciation. This was not intentional and was an unintended consequence of the Tax Cuts and Jobs Act. The CARES Act amended Section 168 to add qualified improvement property to the 15-year property. This technical amendment is retroactive to the effective date of the Tax Cuts and Jobs Act and applicable to property placed in service after December 31st, 2017. Therefore, if there were significant improvements in 2018 that could potentially qualify under the amended qualified improvement property classification, then a company should consider amending the 2018 tax filings and taking bonus depreciation on those additions. Just as with the individuals, the CARES Act also addresses charitable contributions for corporations. Charitable contributions generally means a contribution or gift or for the use of domestic nonprofit charitable organization with respect to which the taxpayer did not reasonably expect to receive a return or financial benefit. Generally, this charitable deduction is limited to the amount to be claimed would be 10% of a corporation's taxable income. The CARES Act temporarily modifies that limitation to 25%, but only for the qualified contributions made between January 1st and December 31st of 2020. One of the last things I want to touch on the for-profit corporation side, for the larger corporations, the CARES Act established the Economic Stabilization Fund and granted the Treasury authority to make loans, loan guarantees, and other investments in support of eligible businesses, municipalities that do not, in aggregate, exceed $500 billion and provide the subsidy amounts necessary for such loans, loan guarantees, and other investments in accordance with those provisions under the Federal Credit Reform Act of 1990. Just high level, notably as it relates to operations of this program, the CARES Act includes several provisions that are of interest, in my mind, to the corporate tax context. The CARES Act section 4003 provides that any loan made by or guaranteed by the Treasury under this section shall be treated as indebtedness for U.S. federal tax purposes, shall be treated as issued for the stated principal amount, and stated interest on such loan shall be treated as qualified stated interest. Something else to note is that this section provides the Treasury shall prescribe such regulations or guidance as necessary or appropriate, including guidance providing that the acquisition of warrants, stock options, common or preferred stock, or other equity under the section does not result in ownership change for purposes of 382. And also, this portion of the CARES Act contains several other restrictions on companies accepting the loans, including limitations on the compensation of executives. It must be only U.S. businesses. It limits buybacks and dividends. It also requires the maintenance of employment levels. So I would say anyone interested in this, I would have to advise them to consult legal counsel with the scope and application of the terms and conditions to make sure that this makes the most sense for their organization. And with that, we will go over your next polling question.
All right, Alan, can you hear me now?
I can.
All right. Sorry, technical difficulties. Thanks, Alan. And because I couldn't talk earlier, I did want to go back real quick to one of the things that Craig said that I think is important. I know I've gotten lots of questions from clients as well as neighbors about the payroll protection loans. And I think there's a lot of information that even the banks are trying to still figure out now, which is one of the things Craig said. And so I think everybody's trying to make their best guess at what the right answer is or what the amount of loan they can apply for or what the amount is going to be forgiven. And it's all still very much in the process. So it's very hard to know a lot of those details yet. I will say the ASCPA as well as the Small Business Administration websites have a lot of resources that they've been pushing out. So if you are looking for a little bit more detail that maybe the lender can't give you or you haven't seen yet, they definitely have some calculators that can help with trying to figure out what the right amount is. And I think that they understand that people are struggling here. So hopefully those are helpful. So anyway, and as Alan said, there's lots of new corporate provisions that hopefully can help companies go back and amend or carry back returns to get some money in these companies' hands, which are all very helpful during this time. So next polling question. Do you expect that the CARES Act will help your business? And we'll give you a few minutes to answer that. Okay, it looks like it's a tie between yes and not sure yet. And I'm not really surprised by that answer because there's definitely a lot of good things in here that will help companies, but a lot of uncertainty as well. As with a lot of these new rules as they get pushed out, it's very high level, but then we need all the details and the logistics of how it all works. So hopefully more guidance is coming on those. And with that, I will turn it over to Jason to go over specifically how a lot of these provisions apply to the not-for-profit entities.
Thanks, Franny. So we thought we'd kind of round out our discussion today of the CARES Act with how it specifically relates to the more nuanced world of the tax-exempt entities. Now, there's very little of the CARES Act that applies exclusively to tax-exempt entities. But it's worth noting that exempt organizations can generally take advantage of all the provisions available to corporate taxpayers, but just with a few caveats. And so a good example of caveats would be some of these great loans that are out there. First of all, the Paycheck Protection Program, which Craig touched on earlier in the presentation, that's the program that allows certain small businesses and nonprofits to borrow funds to cover things like payroll, rent, utilities. This program is only going to be available to charitable or veterans organizations exempt under 501c3 or 501c19. And these organizations are going to be eligible under the same terms of small business. I know there's a lot of questions out there right now. I've been following the Q&A throughout the presentation, and I know a lot of C6s are really interested. So right now, we're looking at just public charity, or sorry, just charities in general and veterans organizations. So what about other exempt organizations, say a social welfare organization or an industry trade association? So these organizations, like I said, are not going to be eligible, but you may still qualify for an economic injury disaster loan. And that's a pre-existing loan program that's been around for a while. And the CARES Act is going to inject an additional $10 billion of funding to try to help some small businesses and nonprofits that don't qualify for the Paycheck Protection. $10 billion doesn't seem like a lot whenever you're trying to get an extra $250 billion into the Paycheck Protection Program. But there is some funding already from the Small Business Administration on that. So hopefully it will be enough to kind of cover everybody. Another important point to cover with the CARES Act outside of loans would be the modified net operating loss rules. These rules would apply to exempt organizations with any kind of unrelated business income. So if you have some revenue streams that are outside of your normal mission, where you're actually paying tax, and it sounds kind of weird to think about an exempt organization that is paying tax, but it happens. These net operating loss rules are going to be in place with the net operating loss rules that were put in place in 2018 as well with the Tax Cuts and Jobs Act. So we're hoping for some additional guidance on this because it's going to get a little bit confusing. Just as an example, right now it's presumed that a loss reported in 2018 or 2019, if you're looking to carry back that loss to any time between 2013 and 2017, it can be carried back to any trade or business that's generating tax. While a 2019 loss carried back to 2018, so not 2013, 2017, but to 2018, can only offset taxable income generated from the same line of business. If that sounds confusing to you, then you can see why we're hoping for some additional IRS guidance on that. Other provisions of the Act that may still be relevant to tax-exempt organizations include the delayed payroll tax deposits and the employee retention payroll tax credit. These provisions both apply to tax-exempt organizations in the same way that they apply to a normal corporate taxpayer. And we should note, similar to corporate taxpayers, charitable or veterans organization that qualifies for these paycheck protection loans, they cannot take that loan and the employee retention payroll tax credit. You have to choose one or the other. As Craig put it, you can't double dip. So choose one or the other, whichever one's most beneficial for you. And finally, the biggest question for exempt organizations right now is the filing deadlines. Right now, there's been no additional extension of the May 15th deadline, and I know a lot of people have been hoping there would be. This could still change. My guess is that lawmakers are optimistic that we will be back to normal by late April, maybe early May. And I'm sort of on the fence, honestly, about an extended due date. On one hand, I know a lot of us have taken a big hit on productivity while we're working remotely. I'm sure you're definitely getting pulled in a lot of directions right now. I was speaking to a client last week, and she was saying that she was basically apologizing that she hasn't gotten information to me that we were requesting, and she mentioned that she has her 7-year-old there, and that was hard enough as it was. But then she also has her husband there as well, which seemed to be, from the way she was saying it, that her husband was kind of the biggest strain on productivity, not necessarily a 7-year-old. So I guess my point with that is a delay is still possible, but I really wouldn't count on it as part of your filing strategy right now. It's still a pretty big gamble, but we'll definitely keep everybody posted on that. So now for calendar year filers, so if you have a December year end, you do still have your normal 6-month extension available to November, but an organization, say, with a fiscal year ending in June, you should be aware that May 15th deadline, that's your extended deadline, is final as of right now. But if that changes, we'll definitely let you know. I know I'm getting a lot of questions about that every day, so I have kind of a list of individuals I'm going to notify right away as soon as we hear anything, if we hear anything. Of course, I do want to mention that on our blog, we have prepared a deadline, an entry on the blog for the deadline where we're going to be watching that. And we've included the most recent article on your resources section of Orange 24, so please feel free to download that and read over it. We will push more out as we get more information. And with that, I believe we have our last polling question.
Yes, thanks, Jason. And thanks I know we did have a lot of questions about which entities which not-for-profit entities can apply for the payroll protection law. And so thanks for answering those questions.
Oh, thanks.
So the next polling question is, which of the CARES Act will impact you the most? As we've gone through with our different presenters today, we've talked about a lot of different places that the CARES Act can impact your organization. So which of these areas do you feel like will have the biggest impact? Okay, not surprising. It's sort of all over the place, which I think is a good thing. Sort of what the CARES Act was trying to go after is to help everyone in different places. So that's probably good news. So as we wrap up, we really hope that you've learned something new today or have at least some more information to take back to your organization in regards to these changes related to COVID-19 and the CARES Act. We realize there is a lot of information related to this, and we feel like we've given you a lot of information, but there's still so much more. So I'm sure as you think about a lot of the things that have been discussed today and take it back to your organization, you'll likely have additional questions. So make sure that you're definitely reaching out. We're happy to help wherever we can. Also, and just as a wrap up, to think about other thoughts, things that aren't necessarily tax specific that are related to the COVID-19 and the CARES Act. The first thing that comes to mind is financial reporting considerations. Many of you guys are probably wrapping up your 2019 audits or definitely in the midst of it, as well as I know we've seen a lot of Q1 financials coming in from the insurance side of things. So in thinking about what all of this means from a financial reporting standpoint, the biggest thing to realize is when you have a change in tax law, you have to consider the financial implications of those tax law changes in the period in which the law was enacted. So what that means is the CARES Act was enacted on March 27th, 2020. So the first financial period that would have a direct impact in regards to these changes would be the first quarter 2020. Now, that said, it doesn't necessarily mean that there shouldn't be considerations for your 19 audits that are still going on. The biggest thing would be any subsequent events disclosures that would need to be considered, especially if there would be significant changes in regards to what you would expect from an operations standpoint or the realizability of any assets going forward based on those 2019 numbers that were reported. So for example, if you had a deferred tax asset that was emitted as of 12/31/19, largely due to projected future income for 2020 and forward. And by the time we're filing the 19 financials, we realize that those projected incomes likely are not going to occur. There would need to be consideration as to whether or not it would rise to a level of needing to be reported for those subsequent events. However, the most impacts are going to come in the Q1 reporting. Some of the considerations there would be same sort of line of thought in regards to what are your future projected incomes? Does that impact your admissibility? I know a lot of times when we're looking at this for statutory filers as of Q1, we rely on what we were told for projected incomes at year end. This likely would not be the case given this year and all of the events happening. We would likely want some updated financial projections, which could impact the admitted asset here. We also, in the same sense, for GAAP filers, would have to consider any valuation allowance needed if the deferred tax assets were more likely than not now not going to be realized due to any of these changes. On a flip side, there could be some benefits that would need to be reported. If you are able to take advantage of any of these leasehold improvement deductions or amended returns or carryback now with extended carrybacks or 100% refundability of AMT credits, we would need to be considering those benefits and booking those on the Q1 financials. Just as a side note, something to consider, if you are able to carry back to a later year now, there's likely a rate change. Anything prior to 2018 would have that higher rate, likely a 34, 35% rate. So make sure you're considering that when you're booking any of these benefits. Two other just quick thoughts. Documentation, as Craig and Alan have talked about, there's a lot of benefits out there, but there's a lot of information that goes along with that. So just making sure you're thinking about those things up front, that you're the paid leave acts, the employee retention credit, these payroll protection loans, the security deferral. Go ahead and set in place what information you need, how it needs to be documented, and get that information ready for your files so that you're not having to go backwards and try to gather this information. I know one of the things we've done on our internal side is making sure we're tracking the sick leave and the emergency FMLA so that we know what each employee is taking. Also, we're tracking it so that we can make sure we're reporting things properly for payroll tax credits. Also, coordination between departments. These kind of things have touched all the departments. Your HR department needs to be involved. Your finance department needs to be involved, accounting, HR, just so that everybody's clear on what the goal is, what we're trying to achieve, and what's being required in regards to information, so that everybody's coordinating up front and that they know what their goal is and can efficiently work together to collect all this information and make sure that it's getting right. So with that, that is all we had for today. We hope that you've gotten some good information. We did have a lot of questions. So there was one or two I wanted to try to cover now. But if we do not get to your question, we will reach back out to you with the answer or at least a response in the next few days. So I appreciate all the questions and answers. It's great. One of the questions we saw a few times is, with the payroll protection loans, if your loan is to be forgiven, is that income taxable? So, Alan or Craig, I don't know if you have an answer to that you could share.
Yes, no, the income will not be taxable if the amount is forgiven.
Great. Yeah, they specifically have carved that out as cancellation of debt as income from the bill. One of the things that we're not sure about, which, it's the beauty of tax, there's always a but if, is whether or not you'll still get a deduction. The income is clearly not taxable, but is the amount of salaries that are considered paid with this forgiveness loan still deductible to the organization or not? So hopefully, again, more guidance will come out for that shortly. There was also a question about the payroll protection loans in regards to the compensation limitations. It does say you aren't allowed to include compensation over $100,000. My understanding is you can include it up to that $100,000, but just not in excess of. It doesn't exclude that salary altogether. So as I said, there's a lot of questions. I know we didn't get a chance to go through all of them, but we will definitely be back in touch. And I really appreciate all of you for taking the time to join today. I hope your working from home situation is going well, and I hope everybody stays safe, and look forward to seeing a lot of y'all again soon.